All right, so let's get started. So the second lecture 2 of the course Introduction to Mathematical Finance by CompatibL. My name is Alexander Sokol. I'm the head of quant research at CompatibL and the company founder. Welcome. So today's lecture is on derivatives and valuation. First of all, we'll introduce derivatives and over-the-counter instruments, and these are not opposite to each other. These categories overlap. And then we'll learn more about equity derivatives and about interest rate derivatives. First of all, what is a derivative? A derivative is a financial instrument whose payments are based on or derived from other financial instruments. Some derivatives are securities, namely, they are trading on exchange, or for example, futures or derivatives like that. But most are over-the-counter instruments, and we'll talk about what this means. A financial instrument or asset on which payments of a derivative depend is called its underlying. Right, so the underlying may be a security or a bilateral instrument. And bilateral instrument is the contract between two parties, right? So in other words, it's not an asset to buy or sell, it's a contract. Sometimes the underlying is not even a financial instrument. It may be a commodity, for example, oil, grain, price of rice. The diagram below shows a first generation derivative based on cash and an asset, such as stock, bond, or commodity. The second generation derivative can be based on this first generation derivative in cash, right? So in this diagram, we have security and cash, and based on them, we have first derivative, which is based on them. And then if you combine first derivative with cash, you can then build on top of it second, so second generation derivative based on the first generation derivative, which is based on something that's not a derivative. So, this cycle can be very long. And some banks and financial market participants got into trouble trading very, very long chains of derivatives, because the more derivatives you have in the chain, the more the risk. But first and second generation are totally safe, very mainstream, and that's what we'll talk about today: first or second generation derivatives. So derivatives and securities are not opposites. Some derivatives are securities. Some first or even second generation derivatives are traded on exchanges just like stock. For example, even though sometimes one exchange will trade stocks and derivatives, sometimes there is a specialized derivatives exchange. For example, many derivatives trade on the Chicago Mercantile Exchange, which is today most of the time just called by its abbreviation CME, and they are considered securities. And they're considered securities because they meet the definition of securities that we learned about 2 days ago in the first lecture. Namely, they're standardized, they're fungible, right? So they're tradable or negotiable, and they have a public price record. So for example, CME trades US Treasury futures, which is a first generation derivative for which the underlying is a US Treasury bond. And options on US Treasury futures, which is a second generation derivative for which the underlying is US Treasury futures. The diagram below shows how these derivatives are related to each other, right? So the future and bond is based on bond and cash, and then option on future is based on future and bond and cash. Anastasia, can you confirm we're recording? Actually, I can see here that we're okay. Good.
Yes, all good.
Right. So the meeting is being recorded. All right. So now, securities derive advantages from their standardization, but there are also disadvantages to standardization. Financial market participants require financial instruments suited to their specific objectives and economic situation. And the closer a financial instrument matches the specific objectives of a single market participant, the more difficult it is for the exchange to match buyers and sellers. Right, so some financial instruments are bespoke. They're customized so strongly to the needs of one market participant that they are not of interest to other market participants, right? And others are of interest to multiple market participants, but not standard enough to trade on exchanges. For example, if sometimes, and it's a kind of a classic derivative example, let's say you have a corporation and you're planning to build a factory in a foreign country. And to build this factory, you need to borrow money. Let's say you plan to start a year from now, and you will be building for the next 2 years. And for each stage of construction, you will need to borrow additional amounts of money. But you would like to have the option of not doing the borrowing because you have not decided yet if you definitely build the factory or not. So that creates a derivative that's very highly customized, right? It has to have a specific option, and maybe this option of buy, build or not to build is linked to, let's say, price of the stock or some other foreign exchange rate. And you need specific dates on which you need the money. So that's a highly customized, bespoke financial instrument. In bespoke, basically when you say bespoke suit, it means a suit that the tailor creates for you from cloth, right? And just like financial instruments, bespoke financial instruments are created for a single market participant by the dealer or bank. Over-the-counter financial instruments, when financial instruments attract investor interest, but do not meet the requirements to become securities, or meet some of the requirements, but not others, there are three, right? So there is it has to be fungible, it has to be negotiable, and it has to be a price record, it has to be liquid. So when an instrument meets none or some, but not all of these requirements, they may be traded over the counter, right? So over the counter, meaning you come to a shop, you talk to a salesperson, and over the shop counter, you get a financial instrument, right? As opposed to an exchange. So an over-the-counter financial instrument is a bilateral contract between two parties to exchange contractually agreed payments with each other, right? So the parties to an OTC instrument are called counterparties, and the payments are called cash flows, even if some of them involve exchange of something other than cash, like, for example, shares of stock or commodity. Sometimes they're called asset flows, and sometimes they're called, just cash flows is more common. An OTC instrument has a term sheet, which is a summary description of contractual obligations of the parties. And term sheet can be used to determine the price of an OTC instrument. And the process of doing so is called valuation. So derivatives valuation, or generally being a valuations analyst, is one of the jobs in financial markets, and that's one of the career choices for people who study mathematical finance. And there are lots of jobs like that at CompatibL. That's one of the things that a company does. But also there are jobs like that for banks. There are also jobs like that at corporations that trade with banks. And generally, it's one of the key professions for graduates of mathematical finance. All right, let me just take one brief moment. I want to stop share for a second. I want to see if I can stop the sound when people join the meeting, because people are still joining. 1 second. Let's see if I can easily. If anybody knows how to disable the notification, let me know. Play sound when someone joins or leaves. I think that's it. All right. Okay, so we're back and can share the screen. All right, so let's continue. All right. By the way, just like in the last lecture, if you have any questions, please type it into the chat. My colleagues will see the chat and alert me, either answer it directly or will alert me. And then at the appropriate time during the presentation, I will answer these questions. All right, so now for over-the-counter, securities and OTC instruments, right? Securities and over-the-counter instruments are opposite, right? So derivatives are not opposite of securities. Some derivatives are securities and some are not. But securities and over-the-counter instruments are opposites, right? And over-the-counter instruments are not completely standardized, right? So some are uniquely, totally unique or bespoke. Others are partially standardized. For example, forward rate agreements and vanilla swaps, and we'll talk about vanilla swaps later today, have standard contractual terms, but different start dates and fixed rate, right? And the meaning of vanilla is plain in this case, right? So vanilla, of course, is an ice cream flavor, but in this case, then you in English you say plain vanilla, which means plain or simple. So meaning of vanilla here means plain, right? Simple. Over-the-counter instruments may, are not tradable, right? And meaning non-negotiable. Namely, for a counterparty to OTC over-the-counter OTC instrument to sell the role in a contract to someone else, the other party has to agree and may ask for a payment in exchange. And the process of the sale is called the innovation, right? It's not like a stock. I buy the stock of Amazon. I don't need permission of Amazon to buy it. Then I may sell the stock to someone else. I don't need permission of Amazon to sell it. right? So in other words, a stock is fungible, right? So OTC instruments are contracts between two parties, and these are two specific parties. Unless specifically provided in the contract, you cannot just say, well, I'm going to give my obligations to someone, right? So sometimes actually the contract says that you can, but in most cases it doesn't. In the process of doing so, it's called innovation, but you need to agree with the other party to do that if the contract doesn't allow it up front. And finally, the meaning of being liquid is different for securities and for over-the-counter instruments because of the different nature. So for securities, being liquid means being easy to buy and sell, right? So there are a lot of buyers, a lot of sellers. If you want to sell a security, liquid security means that on any given day, there are a lot of buyers and sellers, and you can sell your shares. For other over-the-counter instruments, it's a contract between two parties which exchange cash flows. So there's no asset here to buy or sell. Being liquid in this case means that it's easy to find a counterparty that would agree to enter into this contract with you, or agree to terminate the contract at your request for payment, representing the current value of your contractual obligation, right? So in other words, a swap is also quite liquid, but the liquidity of swap means that it's easy to find someone who would agree to enter into a swap with you. And it's also easy to either terminate the swap or to find someone who would enter with you into an offsetting swap, right? So in other words, if you're receiving floating payments, and again, so we'll talk what this means in the future, but they are payments based on interest rate that changes from time to time. So, or fixed payment, that's interest rate that doesn't. So one way that you can sell, quote unquote, right, or exit financial instrument which is over the country is to find someone else who will enter with you into an offsetting instrument that reverses your cash. So any money you receive from one party, you pay to the other party, so you no longer have exposure to changes of, for example, interest rates, right? So liquidity has different meaning for over-the-counter instruments compared to securities. They can still be liquid or illiquid, but the definition is different. Now, we're going to look at two specific types of derivatives today, or specific what's called asset classes, right? So the first asset class is equity derivatives, and the second asset class is interest rate derivatives. We will look at equity derivatives first. And again, so this concluded the first section. So I wanted to remind, if there is anything in the chat, please let me know. I can see there are two messages in the chat, but I don't see anything. So I assume these are not questions, right?
They are not questions.
Right. Okay. Perfect. All right. So now in this, now we're going to learn about equity derivatives, right? And then after that, we learn about interest rate derivatives. Okay. So the simplest equity derivative is single name equity forward. Single name equity forward is an over-the-counter derivative, which stock shares is the underlying. There's a very similar security, which is a slightly different type of derivative, which is called equity futures. So it's beyond the scope of this lecture to discuss, the difference between them. They're very similar. One is traded over the counter. That's the one we will study. The other one is traded on an exchange. And there are very tiny difference between them, particularly linked to related to standardization and the way that you prove to the other party that you are credit worthy, right? So in other words, one of the ways is to post some money called a margin to prove to them that you have enough money to meet your financial obligations. And the way that this works is different, but more or less they're very similar. We will study here equity forward. So single name equity forward is an OTC derivative which stock shares are the underlying. All right, so let me answer the question, right? So is your main idea that many derivatives mostly illiquid? Well, I don't know how to define many. I think probably I would say the opposite is true. Namely, most of derivatives are liquid, simply because liquid derivatives are those that are more popular, traded more frequently, and therefore there are more of them, right? So I think in some way, I would think the opposite is true, right? So most of the derivatives are liquid, but there are a lot of derivatives that are illiquid. Bespoke derivatives are illiquid in a sense that they have very particular structure and interest only one market participant. So you cannot, by definition, find others who are interested in them because they're tailored to the needs of one, right? So the bespoke are illiquid, but most of them are liquid, right? Swaps are liquid. So some of the largest, volume in interest rate derivatives are swaps. They're liquid, so they are very liquid. Some of the largest or the largest volume in equity derivatives are forwards and simple options like calls and puts. They're also very liquid. So actually, no, it's the opposite, right? So there are more liquid derivatives than illiquid, but both exist. All right, so single name equity forward is an OTC derivative, over-the-counter derivative, for which stock shares is the underlying. And single name means that underlying is shares of a single stock, not a group of stocks, such as basket or index. So there are other types of forwards. For example, forward on an aggregate or average price of the group of stocks, which form a stock index, are index forwards. There are also basket forwards when it's not an index that a company like Dow Jones or someone else or Standard & Poor's, right, put together. It's a basket that you define as market participant. But we will talk about single name equity forward, but we'll omit single name, and that's the forward on the underlying, which is the stock. Okay, another question. How are derivatives prices evaluated on the stock exchange? Okay, stock exchange derivative prices are evaluated, very good question, exactly the same way as prices of stocks themselves, right? So on a stock exchange, derivatives prices are evaluated by market makers who establish market clearing price for a derivative if it's traded on a stock exchange, like for example, call option or forward. So they establish market clearing price such that at any given point in time, there is the same number of buyers and sellers for that price, right? If the price is very high, nobody would buy, everybody would sell. If the price is very low, nobody would sell, everybody would buy. So there is somewhere in between the price at which there will be approximately the same number of buyers and sellers. And if it gets a little bit out of balance, the market makers move the price so it gets back in balance. And the market maker only temporarily accumulates a little bit of what's called position or ownership of this security. The objective is to set the price such that they unload it. And at the end of the day, there is something called the closing auction to make sure that all of the positions are closed out. And the market maker is left with no position whatsoever until the next trading session. However, even if the derivative is traded on the exchange, you still need derivatives valuation because stock is really a fundamental price, right? So stock is something that essentially, fundamental analysis, which is the only way to price a stock independently of financial markets, gives you an answer that can be significantly different. And for some of the most exciting stocks, like things like Tesla or Amazon and so forth, they're like multiple times different from what fundamental analysis tells you, because investors build castles in the air. For derivatives, there's a little bit less of that, because derivative price has some very definite connection to the stock price. There is also an unknown in derivative price, and we'll talk about it later, which is separate from the stock price. It's the volatility, right? So derivative price is determined by stock price, volatility or variation of stock price from day to day, and also what investors think about risk. So there is a big element of price discovery there as well. In other words, what fundamental analysis is to stock, derivative valuation is to options, right? So in other words, you can look at historical volatility, you can look at stock price, you can look at other things and say, that's what the option price should be. But in reality, it will be different from that, right? So, and the way to, the price of derivatives is set for on the exchange is price discovery. The greatest value of derivative valuation is to price bespoke derivatives, because bespoke derivatives or illiquid derivatives, they are not traded on exchange. So you cannot do price discovery on exchange. And when you cannot do price discovery in the exchange, what derivative valuation does is that it observes prices of options which are liquid, which are related or similar in some way. For example, there may be options on the same stock. And then build a model. So model is basically a mathematical algorithm for coming up with the price, which takes as input prices which are discovered by trading on the exchange and produces price of a bespoke or a liquid instrument. So on the exchange, just price discovery by matching buyers and sellers. But for something that's not traded on the exchange, or just basically either liquid or does not meet the other requirements, that's where derivatives valuation becomes the primary method of valuation. And when it uses derivatives prices discovered by matching buyers and sellers on the exchange as input, it becomes a lot more accurate compared to models that don't, right? So there's a lot of value. In other words, people who trade simple derivatives in the market, they do it because they need to trade these instruments for their own purposes, but they also provide a public service by helping to price other instruments, because we can use the price discovery that occurs during trading to price other instruments. So it's like a public service basically done by market participants to help people who don't stock trade on the exchange but still want to participate in markets. Any other questions before I continue?
Not yet.
Okay, good. All right, so now, back to equity forward, right? So single name means underlying is a single stock, and equity forward is an obligation to buy a specific number of stock shares on its maturity date of the forward, right? So stock does not have maturity date. We hope if you buy a stock that will last forever, or at least long enough, but forward does, right? So forward has a maturity date. So equity forward is an obligation to buy a specified number of stock shares on the maturity date at a predetermined price for one counterparty, and the obligation to sell it on the same terms for the other counterparty, right? So now it's two parties, two market participants. One agrees to buy no matter what, right? So it's not an option, it's basically an obligation, right? So one has an obligation to buy, the other has an obligation to sell at the predetermined price that these parties agree to in advance. And that's called the forward price, right? And the counterparty that has the obligation to buy is said to have the long position in the underlying, and the counterparty that has the obligation to sell is said to have the short position, right? So long position is something like, a long position is essentially something like owning an asset, right? But in this case, it's an obligation to buy it later as opposed to outright ownership. In short position is obligation to sell, but you can think of it as obligation to buy a negative amount, right? So it's a kind of mathematical way to think about selling is buying a negative amount, right? Okay, so now for the equity forward, there may be physical settlement or cash settlement. So physical settlement means that it's really, one party agrees to acquire the asset and the other one agrees to sell this asset. And that can be stock or commodity and so forth at the forward price. And physical settlement for stocks is a little bit of a nuisance because basically as the time approaches or in advance, you need to buy the stock. If you have an obligation to sell, you have to buy it in advance and then, you sell it to someone. Or if you have an obligation to buy, then you will receive it from the other party. And then if that's not the stock that you want to invest in, you have to sell it, right? So a lot of futures and forward contracts, and we're talking about forwards here. A lot of these contracts are purely for financial means, right? So in other words, a lot of these contracts is, the objective is to get the financial or cash equivalent of doing this transaction. You don't necessarily want to buy the stock. If you get the stock as part of the transaction, you will sell it, right? In this case, it's easier to do cash settlement, meaning the parties do not exchange any actual shares of stock, and one party will simply pay the other what the cost of physical settlement would have been. Cash settlement is even more valuable for underlying which are not stocks. For example, underlying may be grain, right? So you would have, you can have a future on the price of rice. And in case of physical settlement, you actually have to get a rail car full of rice to someone, to the other party. You may not have a rail car of rice, right? This other party may not need it, right? All they want is to protect themselves against price fluctuations in rice. That's like, remember the example from the first lecture about the samurai, right? So in fact, with this futures contracts, the point of these contracts back in 16th or so in 17th century was to protect against price fluctuations. You don't actually need you don't have the rice from the next two harvests in the future, right? So if you have a future with maturity of 2 years, you will need to, and there's a physical settlement, you will need to either store the rice, you need to find the rice, you don't want to do it. It's even worse when it's cattle, right? There is a futures on pork bellies, right? Pork bellies are pigs, right? It's cattle. So when you're buying and selling cattle, you have to feed the cattle, you have to transport the cattle. Not an easy job, right? So cash settlement, simply that the parties exchange the cash that's equivalent to what they would have, money they would have received by selling the underlying. It's a lot more convenient, right? Well, the purpose of having both is because, sometimes people actually do want the underlying, right? But it's a lot more convenient usually to have cash settlement. All right. So now another, by the way, example, just in passing, right? So sometimes for stocks, cash settlement is useful because in some countries, for example, like China, there are restrictions on foreign ownership of nationally significant companies, for example, defense. So if you want to participate in the financial success of the company, but government, and it's not just China, there are many countries where there are similar restrictions. So if you want to participate in the financial success of a company, but government regulations prevent you from actually owning the shares, then cash settlement is one way that you can participate in the financial success and bet essentially on what the price will go, but without having to own the shares. And then you can do it even if you're not permitted to actually buy the shares. So we'll assume cash settlement here. All right, now we came to a very critical point, and I'll spend a lot of time on the next two slides because the slides describe a very important notion that's the underpinning of derivatives valuation theory. And that notion is efficient markets theory or efficient market hypothesis and no arbitrage conditions on the financial market. So efficient markets theory, sometimes it's called hypothesis, but it's really not a hypothesis anymore. It's really a theory, right? It's proven, right? That it states that in financial markets, there are no opportunities for guaranteed risk-free profit. Okay, so all of us have seen advertisements saying here, strategy, trade Forex, right? We will teach you how to trade Forex without risk and make a lot of money, usually with a picture of someone on a yacht. Okay, people who follow this advertisement usually end up not on a yacht, but maybe on a yacht as a waiter, right? So as a sailor. Because there is no such thing as risk-free profit in financial markets, right? So this profit is called an arbitrage opportunity. In its absence, is no arbitrage. And the reason it doesn't exist is because if riskless arbitrage opportunities existed, then people would find them, and people who find them, called the arbitrageurs, and bankrupt those who offer this opportunity. For example, suppose that you decided to sell stock at $1 less than the price on the exchange, right? Arbitrageur would see that you're selling stock cheaper than the price on the exchange and will simultaneously buy a share from you and sell one on exchange. They will earn $1, you will lose $1, right? So then they do it again and again and again until the seller runs out of stock, runs out of money to buy stock, right? Because every time this happens, the markets creating the opportunity for riskless profit would simply, a lot of people will jump on the opportunity and bankrupt the person who is selling, right? Can you still hear me? I think I've sort of a little trouble.
There was trouble for a couple of seconds, but no, it's fine.
Yeah, I hope it works further.
Mm-hmm.
Okay, so all right. Now, this drawing below shows that there is a couple who walked past a pile of money on the ground, right? Because they believe in the efficient market hypothesis. They knew that if there's a pile of money in the ground, there's riskless profit opportunity. And they were absolutely correct not to pick it up because they knew it's an illusion. Of course, on the real street, it's not an illusion. But in financial markets, when you see a pile of money and it seems that there is no risk and you can just take it, it's an illusion. You're missing something, right? So there is a risk you don't realize. Maybe there's a transaction cost you don't realize. If you see in financial markets the opportunity to make money without risk, it's an illusion, right? On the street, it's not, but these people in financial markets, they were correct, right? And this other person who is picking it up is up for a surprise, right? So maybe there is some risk. Maybe there is some transaction cost. Something is really wrong here, and this opportunity cannot exist in financial markets. Okay, but there's a chicken and egg problem here, right? Because if there is no arbitrage, there can be no arbitrageurs, right? And if there are no arbitrageurs, who would then ensure that there is no arbitrage? Well, the reason this really seemingly a contradiction is because in fact tiny, very tiny arbitrage opportunities exist with profits just barely sufficient for arbitrageurs to make money. And arbitrageurs, these are trading strategy, and people tell you that it's risk-free and you make a lot. Not true, right? There is a risk there. Maybe you make money for some time, right? But there is a risk there that is not recognized. If you're a bank or a corporate, you still don't have the technology. To banks and corporates still don't have the technology to take advantage of arbitrage. Arbitrageurs are very highly specialized firms. Some of them are called high-frequency traders, and they make trades with execution time in microseconds, not even milliseconds, but microseconds. These are the people, I was talking to the arbitrager, and he was complaining about how slow the speed of light is, because he was arbitraging trades between Chicago and New York, and it takes a few microseconds, right? Those who are physicists, that it takes a few microseconds for light to get through the fiber optic cable between New York and Chicago. And that's long enough that people who have better cable that has the fastest speed of light, it depends on the density, right? So if you go from microwave towers through the air, your light gets there, like your signal gets there like a microsecond sooner, and you can make the trade first. So these are the people with technology who can make arbitrage in stock trading. Other types of trading, arbitrageurs don't need technology like that, but they need other technology. There is something called statistical arbitrage. So normal market participants, they can assume that there is no arbitrage opportunities because they are so tiny and they get eliminated by specialized firms, arbitrageurs, so quickly that when we are pricing derivatives, we can assume that there is no arbitrage, right? And arbitrageurs actually, they perform amazing public service and they're very brave because, for example, one very well-known in financial markets, very well-known, disaster happened to an asset manager, hedge fund called LTC, long-term capital management, which employed some extremely smart and qualified people, several of them Nobel Prize winners. And one of these Nobel Prize winners, in trying to explain to investors why this firm makes money and takes no risk, would take a nickel, 5-cent coin, out of the pocket and say, we can pick up nickels, 5-cent coins from the floor when nobody can see them, and that's how we make money. Well, the thing is that when you're picking up nickels from the floor, you should make sure that there is no steamroller just behind you, because if you're focusing on picking them up, you can get run over by a steamroller, and that's your risk, right? So this guy here, doesn't see the steamroller. So that's exactly what happens to LTCM. So they were picking up nickels, and one day the steamroller just got behind them, and what they thought was a completely riskless trade of spread difference in interest between two different types of bonds, instead of disappearing as they anticipated with the adoption of the euro, it actually temporarily widened. And the fund went bankrupt and lost money for the investors. So arbitrageurs, sometimes it's not actually truly riskless what they do, right? There is still some risk, maybe very low risk, but a very high loss. And they perform this amazing public service such that we can have the rest of the market participants have reliable way to price derivatives, and that's a basically a benefit to everybody. So they are heroes who help us help financial markets to function efficiently. Okay, there is a question, and by the way, these two slides were absolutely critical points on which a lot of other which basically all of the pricing models, derivatives valuation models are based. So if there are any questions you have about these two slides, please ask them and I'll answer. All right, in the meantime, there's already a question. There are three forms of efficient market hypothesis: weak, semi-strong, and strong. According to your experience, which one is correct? Okay, that's actually a brilliant question. It's not an introductory math finance question. I will be very happy to answer. So please send a message to, with your contacts to the chat or private to Anastasia. I will answer after the lecture. Unfortunately, that's the question which I cannot answer quickly. It's also a very high-level question, and this will distract us from the slides that we need to go through, and I don't think we have time. So brilliant question, but it's not really an introductory math finance question, and more like advanced. Any questions about specifically arbitrage on the past two slides? Okay, so let's continue. Right. All right. So now, how do we use no arbitrage or efficient market hypothesis and derivative valuation? Well, one way to use it is called static replication. So static replication is a valuation technique which involves constructing a static replicating portfolio from a long positive, right, or short negative position. So long meaning buying positive amount, right, short meaning buying negative amount, positions in the instrument underlying in cash. The static replicating portfolio is designed to make exactly the same payments as a derivative instrument it replicates in all future states of the world. And static replication is not always possible, but when it is possible, right? It's not possible when it's what's called an option, right? So when one of the parties has a choice to do something or not to do something. But it's often possible when there is no choice, when the two parties, like for the forward. So one party agrees to buy, the other party agrees to sell, there's no choice, right? So that's one of the cases when static replication is possible. So when it's possible, no arbitrage condition, right, or efficient market hypothesis means that the price of a derivative instrument is the same as the price of investing in a replicating portfolio, right? Because if the replicating portfolio would have different price of entering into it than the price of the derivative, in this case, there will be arbitrage between buying a derivative or entering into a derivative and then entering into the reverse position in the replicating portfolio. And that arbitrage is exactly the same as with buying and selling the same stock at a different price. So no arbitrage condition tells us that derivative price is equal to the price of the replicating portfolio. And all of the derivative pricing models are based on replication, right? Either static replication we're talking about here, or dynamic replication, which we'll talk about a few slides later. So when calculating the price of investing, in something, right? So long position is treated as adding to the price, and short position is subtracting to the price, right? Or adding a negative amount. And because the price of the replicating portfolio is a linear function of the underlying price, an instrument for which static replication is possible is called a linear instrument. All right, so valuation of equity forward by static replication, right? So let's put this to real use, right? And let's calculate the price of the forward derivative or derivative of the forward instrument. Let's assume that the underlying is one share of stock that currently trades at the price S, right? So I hope, one second, so I hope this window is not blocking it, right? So it currently trades at price S, and the forward price is 100. Let's also assume that the stock does not pay dividends to its owner, and let's assume that there is discount factor is equal to 1, or in other words, interest rate is 0, right? Just for simplicity. In fact, of course, they're not equal to 1. So discount factor is not 1 because there are interest rates, but for this simple model, we will first assume it's equal to 1. The static replicating portfolio for the forward consists of a long positive position in one share of stock and short negative position in $100 cash. So the price of entering into the replicating portfolio, into essentially acquiring the financial position, is buying one share of stock for $S and then basically making an obligation to give someone $100 cash, or rather, more precisely, you're buying the stock right today, and then you're making an obligation to then give 100 to someone. So it's S minus 100. In the equity forward price, or the price of this replicating portfolio, which no arbitrage tells us should be the same as the equity forward price, does not depend on the volatility. Volatility, as we studied in the previous lecture, is the amount, average amount, or mean square of the change in the stock price overnight, from one day to the next. Right. So daily volatility, or vol, is financial markets or quants, or people who build derivatives models call it daily volatility, or they abbreviate it to vol. Daily vol is the mean square average of the change in stock price from one day to the next. But for forwards, it does not enter the forward price, because we only need to know the price of the replicating portfolio today, not in the future, right? Because in every state of the world is static replication. So this portfolio that we construct today, we don't need to change it in every possible state of the world, independently of what the stock price will be. It will be equivalent to our forward, right? So what it means is that the price of the forward is the same as the price of the replicating portfolio, in S minus 100. So when the stock price today is 100, it costs nothing to enter into the forward, so the price is 0. If the price today is 105 or 95, then if it's 105, it's $5. Otherwise, it's minus $5, right? So meaning that $5 means that if you find someone to take over your position, they will give you $5. Negative means that in order for someone to take over your position, because remember, derivatives are bilateral contracts, or rather, sorry, over-the-counter derivatives are bilateral contracts. You cannot just sell it. You need to find another party to assume your position. So if the price of the forward is 5, you get $5 from someone who will assume your position. Maybe a little bit less, because that's called a bid-ask spread, right? Because the party who takes over your position has to be paid for the service of doing this for you. So there's a tiny difference, but it's $5 minus a tiny difference. If the price of the forward is minus 5, it means that you will find someone to take over the position, and you have to give them $5 for the service, plus again a tiny bit more, because they're doing it for you. All right. So, and the linear instrument is because the relationship between stock price and the price of the forward is a straight line, right? So it's a linear relationship. That's one of the reasons it's called the linear instrument. All right. So now we're going to options. Again, if there are any questions, please let me know. The options, we talk about single name equity option, is an over-the-counter derivative for which, just like for the forward, stock price is the underlying. The option buyer, or first counterparty, has a right, but not an obligation, to buy a specified number of stock shares on its maturity date. Again, option, but not the stock, has the maturity date, for a predetermined price called the strike price. The act of exercising the right to buy is called option exercise. The option seller, or the second counterparty, has the obligation to sell on the same terms as the other counterparty, but only if the option is exercised by the buyer. So the first party, the option buyer, or the option owner, the party which has the option, has the right but not an obligation. The other party has an obligation, but this obligation will only come to pass, right? So it will only be required if the first party decides to do it. So option buyer has the right, option seller has the obligation if option buyer chooses to exercise the right. The option is called call option when the buyer has the right to buy shares. So it's like call, come to me, right? When option buyer has the right to sell shares, it's called the put option. So I take something that I have, I put it away, I don't want it anymore, right? So it's option to sell. And the option cannot be priced by static replication, because in some states of the world, the option buyer will exercise the option, in others they will not. So depending on whether or not the option is exercised, replicating portfolio is different, while static replication requires it to be the same. And static replication only works for some derivatives, but dynamic replication always works. That's a kind of interesting thing, right? So static replication only works for linear derivatives, but you can prove, and the proof is quite complex, but you can prove that dynamic replication also always works. In the way dynamic replication works is it involves selecting a time horizon, constructing a different replicating portfolio in each state of the world for this horizon, and averaging portfolio prices over the probability distribution for the horizon. And because you take the average over the probability distribution, and what is the probability distribution of, right? Stock price in our case. So the option depends on stock price. Stock price, which is $100 today, it may be 105 in the future, it may be 95, and maybe 80 or 120. So there are different stock prices in the future. And there is probability of these stock prices in the future. When you do dynamic replication, you construct a replicating portfolio for each of the future possible stock price, and then average these prices of replicating portfolio over this probability distribution. And because of this averaging, the derivative price, when there is an option, when it's a not a linear instrument, when there's an option, somebody has an option to do something to basically exercise or not, derivative price, option price depends on the volatility. Because if the volatility is low, the future price is close to 100, the initial price. If the volatility is high, it could be very different. This will affect the averaging. This will affect the possible probability of each stock price in the future, and will affect the price of the derivative, which is the average. So generally, to perform valuation for an equity option by dynamic replication, would have to start at maturity, which is the last date that the option still exists, and work backwards in small time increments until we get to time equals 0, right? So if there is a generic kind of derivative instrument, we would need to start from the maturity of the instrument. And at that point, we can construct a replicating portfolio from the underlying and cash. And then we will go back one day. And in this case, we construct the portfolio from underlying, cash, and the price of the instrument one day later, and go backward again and backward again. So in the most general case, when this exercise decisions depend not only on the underlying price, but also on the future price, there are options, for example, called American or Bermudan, where you're choosing between exercising right away or exercising in the future. And to make this choice, you need to know what the derivative price in the future will be. So the replicating portfolio may sometimes depend on the future derivative price. And by backward induction, you're working from maturity of the instrument, let's say 1 year from now, back to today. And at every step, you're using what you just computed for this following day. But our option only has exercise and cash flows at maturity. And we only need to replicate at maturity date. So what I'm going to describe is a simplification. And this simplification only applies to options with European exercise and European exercise. And it's simply because in Europe, this type of options, they're called European and American because European exchanges traded one type of options primarily, with only 1 day. American exchanges traded another type of option, and Bermuda is an island in the middle, right? So that's how historically names appeared. Of course, today, both types of options are traded everywhere. We have a question. So when we replicate a portfolio, are we doing this from the investment bank side, or do investment funds use this? Yeah, so both use this, right? So when you replicate a portfolio, you do it from your side, right? So if you're a financial market participant, if you're at a bank trading with the investment fund, you replicate from your side. If you're investment fund trading with the bank, you replicate it from your side, which is the opposite of the other side. And for a linear instrument, one price is equal to minus the other price. But when there is also an option, right? In this case, you have to remember that there are cash flows you exchange. There is also option you own. But still, any derivative instrument is a contract between two parties, and it's a zero-sum contract. So if the derivative price for one party is X, the derivative price for the other party is minus X. So if you investment fund, you can also do it from the bank side. Just don't forget to put minus in front. All right. So because our option only has exercise cash flows at maturity, we only need to replicate maturity date, right? So let's now do the pricing in the simplified two-state model, right? So this two-state model is we're going to assume that today the price is 100, and the price at maturity has 50% probability to be 105 and 50% probability to be 95, right? So it's a very simplified model where future stock price 1 year from now can only have two values, 95 and 105, and each value has 50% probability. So the price of the equity option is the average of replicating portfolio cost for these two states of the world, right? So if the stock price at maturity is 105, is more than 100. So the option buyer can make $5 by exercising the option at the price. So strike price is 100. We have the right, but not an obligation to exercise. If we exercise, we make $5. So we will. Why not make $5, right? So that means that, that's called expiration in the money. So in the money means the option holder or the option buyer decides to exercise and makes money from that, right? Because otherwise, why would they exercise? So option payment in this replicating portfolio, in this case, is the same as for the forward because the exercise happens. So in the state of the world, when the price is 105, the replicating portfolio is stock minus $100, and the profit is $5 because you're basically receiving the stock that's worth 105, but you're paying 100. So you made $5 by exercising, and in this state of the world, you earn 5. If the stock price is 95, the option buyer will lose $5 by exercising the option, so they will decline to exercise, right? Why would you exercise and lose $5? You have the right, but not an obligation. So you say thank you, but no thanks, right? And then that's called expiration out of the money, right? So when the option expires out of the money, you wasted the money spent on the option, right? You had option, so you had the option, so you had the right was valuable to you, but in the end, you didn't use the right. However, if you exercise, you lose even more money, right? In this case, you lose the price and you also lose extra money. So in this case, you say, well, I paid for this right, but I didn't use it, and that's fine. I'm glad you had it. I had it, this right. So you will not exercise. In this case, the price of replicating portfolio is 0, and the replicating portfolio is just not having any portfolio. So with our dynamic replication, we have 50% probability of $5 profit, 50% probability of 0 profit. And again, there are a couple of simplifications here. So one of these probabilities are actually not the actual probabilities, but something called risk neutral probabilities, which also adjust for the risk that investors take. But again, this is not an introductory lecture topic, right? We will, however, cover this topic a little bit later today when we talk about the next lecture. I apologize. So we will cover the market price risk later in this course. But for today, we'll just assume that these are probabilities without specifying, what kind of probabilities. And these probabilities are each 50%. So we'll make on average $2.50. And by no arbitrage, it means that the option is worth in this model, in this world where stock can go to 105 or 95 and each with 50% probability, the option price will be $2.50. Okay, so now let's calculate how the option price depends on the stock price, right? So previous calculation was for 100. Previous calculation was assuming that this price today is 100, but let's assume that the price today could be different. If the price is 95, I'm going to go quickly, but you can verify it, right? So if the price is 95, in this case, there is a 50% probability of a price 100 and 50% probability of 90. In both cases, you don't want to exercise, right? Because in one case, you just get 0. In another case, you lose $10. So the option price is 0. So if the stock price today is 95, the option price is 0. If the stock price today is 105, same calculation, the option price is 5. If the stock price is 110, then price is 10. And when you do it for a couple of other prices, you will notice that for any price below 95, the option always expires at the money. Basically, if the price today is below 95, then both two of the prices, right? So we're assuming that the model says that the price has 50% probability of going up $5, 50% probability of going down $5. So if the price is below 95, it never reaches the strike price. So the option is always worthless. Below 95, below the stock price level of $95 today, the option is worthless. So the price is zero. If the price is above 105 today, then you exercise on both cases. And in this case, the price is the same as the forward in this linear. And in the middle is something, basically it's also a straight line, but with a lower slope. So it looks like this, right? So option price below 95 is zero. Above 105 is same as the forward. And here it's also linear, but with a lower slope. Okay, so let's now improve our model and assume that there are four-state model, because the previous model is not realistic, was not realistic in one way. So the direction of the move in the stock price was random, but the magnitude of the move was always $5. In reality, of course, the magnitude of the move over 1 year is not exactly $5. It's also random. So we will improve the model by assuming the stock has 25 probability to change by $7.5 or $2.5 in either direction. So in this case, we have random direction and also random magnitude, more realistic model. So in this case, if we repeat the same calculations, we will see that it's also zero below 95. It's also linear above 105. And here, excuse me, instead of two segments, so instead of one segment, there are several smaller segments, which all basically have slightly different slope. And they kind of provide kind of sort of a smooth transition between these limits, right? And if we keep doing it and assuming even more realistic models in which the stock moves in very small increments daily, and instead of discrete, binomial or quite like, our first model had binomial distribution, right? 2 possible states, right? So our second model has quadrinomial, right? So there's like 4 possible states. So now we assume that there is a continuous distribution. If you assume that the stock has moves continuously, and the moves are not correlated, it's like a random walk, basically, there's no correlation between the moves, then you will assume that then the distribution, it will be a random walk or winner process, and the distribution of the endpoint will be Gaussian, right? And that's exactly what happens when the stock moves daily, driven by tiny news, right? So, something happens in the world, industry, good news about the industry, bad news about the industry, good news about the inflation, bad news about the inflation. So every day there are some news that move the stock. And if we assume that this is a random walk or winner process, then the endpoint will have a Gaussian distribution. And to be precise, is the change of log of the price that is Gaussian, right? So again, unfortunately, it's beyond the scope of this lecture. Just to provide some context, we're trying to compress a multi-year mathematical finance education into 4 lectures. So regretfully, I cannot do it. The same. I cannot cover all of the same materials that mathematical finance graduates would learn, right? So we cannot go into log normal models and why it's the log and not the price itself is Gaussian, but it's not a huge difference, right? So in reality, is Gaussian is the log, but in our simple model, we assume that is Gaussian. Price is Gaussian itself. When the change is not very large, they're almost the same because log is locally log is close to linear. Right, so we'll ignore this distinction. In this case, it will look something like this, right? So our 4 transitions, our 2 transitions become 4 transitions. Now it becomes kind of a continuous smooth curve, which approaches, well, in this case, with this tiny increments, I actually go above 105. The stock can be below 95. So the option price in this case is a function of stock price. It will never exactly be equal to the forward. Will approach it when the stock price is high. It will never be exactly 0, but will approach 0 when the stock price is very low. And it will have a kind of a continuous transition, which looks like this. And that's the price of equity option. And now we're ready to go to interest rate derivatives, on which we spend the remaining half an hour of this lecture. Do you have any questions about equities? It would be a good time to ask. Okay, so no questions so far, but feel free to type them in the chat. All right, now interest rate derivatives, right? So we start from the simplest interest rate derivative, which is or rather interest rate instrument. It's not even a derivative yet. called the zero coupon bond. This instrument is traded on the financial markets, especially for short maturities, but it's not the most popular instrument. But it's absolutely essential and very important instrument for constructing interest rate derivative valuation models. So we'll study this instrument not because of its prevalence, even though they are traded for short maturities, but because of the importance of this instrument for model construction. All right, so zero coupon bond is a bond that has only the principal, but no interest rate payments. So for a fixed rate bond, the issuer sets the fixed rate so that the bond price is 100. And this cannot be done for zero coupon bond because it does not pay interest, right? So remember, we studied fixed rate bond in the previous lecture. And we concluded that it's like the clock, which, basically because the issuer of the bond is setting interest such that the price at when it's issued first is equal to the principal. The price of the fixed rate bond is equal to the principal when it's issued and also at maturity. For zero coupon bond, it cannot be done because there is no rate to set, right? So it does not pay interest. It only pays the principal. So instead, 3 month, let's say there is a zero coupon bond with 3-month maturity. So zero coupon bond investor makes money on the difference between the cost of buying the bond from the issuer at this price and then receiving the principal of 100 later, right? So today you buy the bond at whatever price there is, and 3 months later you receive the principal. So you don't receive any interest. You make money or lose money on the difference between these two amounts. So this chart shows the possible price trajectories of a zero coupon bond without the associated random noise, right? So normally, the bond price would go up and down. So this thing, let's assume that it just, interest rates remain static. So unlike for fixed rate bonds, zero coupon bond is a clock which shows correct time only once a day. So remember, fixed rate bond is like a broken clock which shows correct time twice a day. For zero coupon bond, it only is like a clock which shows correct, like a 24-hour clock. It shows correct time only once a day. Namely, it's only equal to the principal at maturity, right? So at origin, the price is different because there is no interest. And now we have the poll, right? So do you think the price of zero coupon bond can exceed its principal, right? So the price of discount bond with $100 principal at maturity is 100. Can the price of a zero coupon bond exceed $100 before maturity? And the possible answers to the poll are yes, it can be above or below 100, or it can be only below 100. By the way, don't pay attention to the chart. It just shows below 100, but there are two possible answers. So let me launch the poll. All right, so I shared the screen. So who thinks it's 1, right? Raise your hand. It can be above or below 100.
Well, 10, 11 people think this variant.
Okay, and who thinks, okay, so let's lower the hands, right? And who thinks it's always below 100? Eight.
8 plus 1, 9.
9, pretty close, okay, right.
Yeah, very close.
All right, okay, so sounds good, right? So, okay, so the answer, yes, it can be higher than 100 if the interest rates become negative. So the first answer was correct until, I would say not recently, but back in the 70s, 80s, even 90s, the first answer was absolutely correct. In fact, if a model for the interest rate derivatives valuation predicted negative rates, it was considered to be actually a bad thing, right? So it was assumed that interest rates can never become negative. And zero coupon price in this case would always be below principal. But since then, our central bankers have decided that negative interest rates is a thing, and that they're appropriate in certain situations. I'll talk about it a bit later. And what does a negative rate mean, right? It means that bond investor is not rewarded for lending money to the issuer, but has to pay for it, right? And the reason they exist is because negative interest rates are created deliberately by central banks to get the economy out of a crisis. So the idea is relatively recent. And there are even negative rates on steroids, which are called quantitative easing, when the banks not only set the rate below zero, but also they start actually buying securities from people. So, so essentially, the idea is that when you lend money to someone, you also give them additional money, negative interest, for safekeeping your money, right? And the reason why investors accept negative rates where they can exist, right, is because the expense of accepting your deposit, if you're a bank, the expense of accepting your deposit, guarding your deposit against the hackers, paying for branch locations, clerk salaries. You come to the bank, you say, give me, I would like to withdraw my money. The clerk says, yes, no problem. It exceeds the amount of profit. Sometimes it exceeds the amount of profit the bank can make lending your deposit to third parties, right? But other than for small amounts, you cannot, or rather should not, maybe you can, but you should not store the cash under your mattress. Even if you did, you would probably hire a security guard, you would probably install an alarm system, and it costs money. So when the central bank offered loans at nearly zero cost to restart the economy after a crisis, the banks also have to lower the rates, and profit from lending may fall below the cost of accepting deposits, right? So in other words, the interest rates that the bank earns by taking money from you and giving it to some people, for example, who want a mortgage, right? If you subtract all of the expenses, they don't earn enough, right? So they have to, in this case, the depositors must partially subsidize the storage of their deposit, right? So think of it, basically you give money to someone and they say, well, I need to pay for a security guard and for the alarm system, right? So you say, well, here's some extra money to pay for the security guard. So normally they pay money to you because they can make even more by taking your money and lending them out to someone who needs to buy a house, for example, or finance a company. But when the economy is coming out of the crisis and the central bank says, here, come, we have infinite resources, where the government, we collected taxes, maybe we printed some money, here, we can give you money to you for free, right? Then the banks, in order for someone to come to them, they have to lower the rates almost to zero. And that may be shocking if you're in Europe, especially in Eastern Europe. But in the US and a lot of countries in Western Europe and the European Union, until recently, no longer, right? But until a year ago, you could practically borrow money for buying a house at almost zero percentage rate, but no longer because inflation is here. So the depositors, when the interest rates are low, must partially subsidize the storage with the deposit. And rates can go negative, right? Negative rates are usually small, a fraction of 1%. Anything higher, and the investors will look for other ways to store the money. Longer-term deposits, risky but interest-paying corporate bonds, foreign currency purchases, stable coins. Also, as we recently discovered with Luna, right, it's very risky. So, however, negative rates, they cannot be minus 5% for as long as there is cash, but they can be like minus 1% or minus 5%. So, pricing zero coupon bond by static application, right? So zero coupon bond has one cash flow that we need to value: the payment of $100 principal at maturity of 3 months, and the other cash flow is the payment of its price. So we previously defined in the previous lecture the discount factor is the value today of a fixed dollar payment at time t capital. And that's exactly the zero coupon bond, except times 100, right? So here we have a fixed $100 payment. So the price of the zero coupon bond is the principal, $100, times the discount factor. And note that maturity time t capital and time t small, when you observe the price, they're not the same, but they're different. Okay, now that we've done the zero coupon bond, which turns out to be the same as the discount factor, and the price is equal to the discount factor times principal, let's look at more complex instrument, the cash deposit, and then the interest rate swap. So for the cash deposit, again, so to understand a derivative, we must begin from its underlying. For interest rate derivatives, right? For equity derivatives we studied earlier, underlying is the stock. For interest rate derivatives, the underlying is the floating interest rate paid by banks on short-term deposits. So floating, as opposed to fixed, means the rate can go up and down depending on market conditions. And in the past, the rates used as underlying to interest rate derivatives were mostly for borrowing over the 3 months or 6 months term. And these rates had names like LIBOR, EURIBOR, TIBOR, right? And the word, for example, LIBOR is an acronym where IBOR means interbank offer rate, right? So IB, interbank offer or offer are rate, namely the rates that the bank offer on 3 or 6 month deposits or other maturities. 3 and 6 months are most common. In the first letter, in this case L, usually refers to the city with the rate is set. So L stands for London, T stands for Tokyo, EURIBOR stands for the euro rate, right? It's not named after a particular city, but it's named after a currency. Now, recently, and it was like a long transition process, but at the end of 2021, so past December, LIBOR rates were mostly discontinued for new instruments. In the market switched to using more reliable overnight rates as underlying. And these rates have names like SOFR, EUROSTR, or SONIA, right? And the overnight rates are fixed or measured for borrowing period of 1 day, right? So LIBOR rates, TIBOR, EURIBOR, and so forth, were measured for 3 month or 6 month deposit. Overnight rates are measured for overnight deposit. And the reason this happened is because, well, there are a couple of reasons. So one of that the process for setting this 3 months or 6 months rate was not reliable, but also when you set the rate based on 3 month deposit, some of this rate is also related to how creditworthy is the other parties, right? So in other words, it's not just the time value of money. It's not just the value of dollar today versus the value of dollar 3 months from now. It also depends on, and we studied in the first lecture, on the credit spread, right? On the survival probability. In other words, it's not just the time value of money, but also you pay less for a dollar 3 months from now if you need, because you need this dollar, you know, it will be better to have the dollar for the 3 months, right? But also this other party may not give it back to you because they may go bankrupt. So the longer the rate, the bigger is the component that has to do with not interest, but with credit. So by making it overnight, it becomes the rate that's exclusively, almost exclusively with very high precision, is related to time value of money or interest. Because if the bank is okay today, it's very unlikely it will default tomorrow. It's possible, but it's very unlikely. Whereas for 3 or 6 months, a lot can happen, right? Some, you know, basically world crisis may happen. Question, why interbank? Why not different rate, right? Well, the first part, why interbank? Well, because when banks lend to each other, there's a kind of a standardized rate, and it was assumed that the probability of bank default is small. So it was like, you know, this rate has lower component of credit or the risk that somebody would not return the money compared to lending to corporates. So when a bank lends to corporates, to corporation, to, you know, a company, right? They charge higher rate because corporation is less regulated, more risky, is more likely it will go bankrupt. Previously, it was assumed that banks can never go bankrupt. Lehman Brothers did back, you know, during the financial crisis 10 years ago. And that's when started this whole process that eventually led to the elimination of LIBOR, because people realized, so market participants realized that the banks can also go bankrupt, right? And why not a different rate? Well, you know, it is a different rate. So with the LIBOR also, there was one problem with calculating it because it was not based on actual transactions. LIBOR rate is based on what the banks report is what they would do, as opposed to what they actually did. And there was an accusation that the banks manipulated this rate. So the banks agreed with each other that they will all report slightly wrong rate to make the business look better and to make, you know, to basically change the perception of how much risk they take. So especially during the financial crisis and even before, there was what's called a LIBOR scandal, right? Or, you know, basically when bankers were caught changing the rate, not what they would lend, but basically reporting to this committee that was publishing the rate a different amount. So again, you know, we're already cutting pretty close. We'll probably finish 5 minutes late, and that's okay because we also started 5 minutes late. But if I keep talking about it, we'll be even more late. So, this is all on Wikipedia and so forth. It's interest, has some historical interest, but the bottom line is that rates such as LIBOR rates based on deposits of 3 to 6 months were eliminated as underlying to interest rate financial instruments and replaced by rates which are based on overnight lending. But the payments still occur every 3 to 6 months because there will be a lot of administration overhead to pay every day. So the rate on which the payments are based is observed every day and then either averaged or compounded, means reinvested, for the payments to occur at the old frequencies of 3 to 6 months, right? So only the rate observation is for overnight, but the payments are still have 3 to 6 months frequency. Now, the cash deposit, right, is an OTC derivative whose purpose and cash flows are similar to the zero coupon bond, right? And the way it works is that in the beginning, you calculate, so there's a calculator icon here to indicate that that's when calculation is happening. You calculate what the interest rates are, what the prices of zero coupon bonds are, and then you agree that one party pays the other the principal, and then after 3 months, this party pays the principal and fixed interest. And this interest is calculated to fix in the beginning, right? So you agree today what you would pay 3 months from now, which consists of basically you pay the principal of $100, and you agree that at the end of 3-month period, you receive back the principal of $100 plus a fixed interest amount, which you determine today. So it's just like the zero coupon bond, right? So here, basically, you pay one amount today, we receive hopefully a large amount 3 months from now. If the rate is negative, it's actually a small amount, right? But somebody, which you pay for safekeeping your money. And otherwise, it's equivalent, right? Okay, so now the instruments or cash deposit is financially equivalent to zero coupon bond, except the bond is a security and basically is fungible, but the cash deposit is a derivative. Interest rate swap is different, and it consists of cash deposits, a series of cash deposits, some of which start today and some of which start in the future. Now, vanilla interest rate swap, or interest rate swap, and vanilla meaning, again, plain or simple interest rate swap, is one of the most widely used over-the-counter derivatives. So it's one of the most frequently used liquid derivatives with the highest volume meaning the amount of money invested in this derivative, right, or the highest principal amount. And its purpose is to exchange the stream of fixed payments for a stream of payments linked to a floating interest rate. And the reason it's so popular is because it serves a very specific and extremely important business purpose. If you're a bank, right, and this diagram below shows, how the bank works. If you're a bank, you have two parts of your business. One is that you take money from account holders, right? And that's the principle that the money, the account holder or depositor, right, puts the money in the bank. And the depositor receives floating interest based on the current percentage rate. So in most banks, the interest they pay you is based on whatever the interest rates are today. So maybe 1 year ago they were low, now they're higher. So interest paid by the bank to the depositors changes. Okay, so the bank also has another line of business, which is to provide mortgages, right? Financing for buying a house, a loan to buy a house. Most mortgages are based on a fixed rate, right? Because people have a fixed salary. So if the amount of money that was paid on a mortgage was based on the floating interest rates, a lot of people would either go bankrupt when the interest rates rise, or if they're conservative, they would have to buy a lot smaller house or not buy a house at all, because they would say, well, today the payment would be, let's say, $500 per month. But if the interest rates rise and if the payment was floating, it could go to 1,000 to 1,500, and the salary may not cover it, right? So in this case, you say, well, I'm going to buy a much smaller house, so even if the rates go up, I still can afford it. That's not good, right? Because you want to have some predictability. So banks receive money and pay interest, which is floating. However, when they lend money for buying houses or financing factories and so forth, not always, but most of the time, they receive interest which is fixed. So the bank has a problem, right? Because now the bank has to worry about bankruptcy, right? So the bank made it right for the homeowner by making the interest predictable. So somebody can say, well, my salary is such and such, and I can afford $500 per month in a mortgage, right? But now the bank has the risk, right? So the bank removed the risk. Normally, financial markets, it's about buying and selling risk. We'll talk about it in the next lecture. So the bank took the risk away from the homeowner, and now the homeowner has no risk, but the bank does. And the bank now has huge exposure because if the interest rates go up, they will be paying a lot more interest than they receive, and the bank may go bankrupt. So the bank would also like to transfer this risk, right? Again, financial markets is about reducing risk and giving risk to people who wish to take risk, and they're paid for it, and helping other people who don't want the risk, who want predictability, to pay a little bit and have predictability. So the bank will go to a dealer, which is also a bank, but much larger and better financed bank, right? Think about like Citibank, right? As opposed to your local bank. And the bank, the dealer, right, will enter into a swap with the bank that takes deposit and, and gives loans for homes, mortgages. In the swap would basically, the bank would pay fixed interest that it's receiving from the mortgages to the dealer. And the dealer would pay floating interest, which the bank here on top, right? So in other words, fixed interest goes to the dealer, floating interest is coming to the bank, and then it's paid to the account holder. In this instrument, which exchanges fixed interest for floating interest, is called fixed leg, is the leg or part of the swap, which is, so swap stands on two legs, right? So one leg is a fixed leg where there is a receive, so the dealer is, so the bank is paying fixed interest, and the bank is receiving floating interest. So this instrument is so popular because most of the commercial banks that take deposits from people and give mortgages, basically issue loans to buy houses, are in the same situation, and dealers help them to reduce the risk. And that's what makes it so popular. Okay, now, in order to price it, we need to count cash flow. So here's a little poll. I'm not even going to try to launch it. So put your hand up if you think that when software engineer or derivatives valuation analyst says something has priority 1, do they mean it's the most important priority or the second most important priority? First answer, raise your hand if you think it's the most important priority, priority 1.
Three people.
Okay.
4.
Who thinks it's the second most important priority if it's priority 1? Aha, okay, clearly winning. Okay, right. So I can see that a lot of software engineers here. Exactly, they know. That's right, yeah. All right, yeah, well, you're absolutely right. So software engineers, and as I mentioned before, many of the derivatives analysts also have to be software engineers because you write the code in Python or C++ if you're in high frequency, or C, even if you're in high frequency, but normally these days in Python to do models. And in Python, as well as most other programming languages, the first index is 0, right? So when we're counting, remember that the first time has index 0, in the second time has index 1, right? So it's 0 based, right? You start from 0 when you're counting. So watch the indexes because it's very important to count it correctly. So vanilla swap is an agreement between two parties, in this case the bank and its dealer, to periodically, for example, every 3 months, exchange fixed interest rate payments for floating interest payments. And the floating payment is based on overnight rate, which is observed daily and then either compounded or averaged. For example, if there are 20 business days in a month, it's either reinvested 20 times or averaged from 20 observations. And the first payment covers the initial period from T0 to T1, and the next payment covers the next period from T1 to T2. And swap normally is struck just like the bond issuer would set the interest such that the bond is equal to the principal at issue. For the swap, the dealer would set the fixed rate such that no payments change hands in the beginning, right? So in other words, two parties enter into a contract without any upfront cost to exchange floating interest for fixed interest. And typically, the payments are different. For example, in the beginning, fixed is more than floating. In the end, floating is more than fixed, right? So typically, depending on how the discount factor depends on time. Usually, in the beginning, there is primarily one direction of payments. In the end, there is primarily another direction of payments. But on average, they're the same based on our replication model that we will build in a moment. And there is no cost to enter into the swap. The fixed rate that you pay is set such that the swap is fair, right? So in other words, that makes the floating leg equal to the fixed leg and price, right? And the total price of swap 0. So that's the last slide. And here we're going to build a replication model for the swap. And this is probably the most complex formula in the whole lecture today. So you should go for it, right? So first of all, the swap is equal to principal times the difference between floating and fixed payment. And there are, I is the index of the payment, right? So for example, if it's quarterly for 30 years, it would be 120 payments. So I would go from 0 to 119, or, basically because we're counting from 0. Okay, floating rate is equivalent, right? It's based on observations, but is equivalent, it's the objective of it is to provide the financial equivalent of borrowing money for the period that we're talking about. For example, it may be a 3-month period starting 10 years from now. From 10 years, so TI will be 10 years, and TI plus 1 will be 10 years plus 3 months. So floating rate is based on the overnight observations, but is specifically designed in such a way that it's financially equivalent to borrowing money for this 3-month period starting in the future. And by static replication, it's equivalent to 0 bond price expiring at 10 years minus 0 bond price expiring at 10 years minus 3 months. And we already know that the price of 0 bond is discount factor times the principal. So the floating leg is discount factor of TI minus discount factor of TI plus 1 times the principal. Okay, now the fixed leg is a fixed amount, right? So you obtain the interest equal to fixed rate times the year fraction. What's the year fraction? The year fraction is because the interest rate, fixed rate, is usually measured annually. So if you are paying interest over 3 months, you're receiving 1/4 of the rate, right? And then you're receiving it at the end of the period together with the second cash flow. So the price by static replication of this fixed payment is amount of interest, which is principal times fraction times the fixed rate, and you receive it at TI plus 1. So your value, the value today to you of the dollar at time TI plus 1 is equal to discount factor of TI plus 1. So that's the fixed rate. So that's the swap formula, and it appears complex, but we just assembled it from 0 bond prices. In 0 bond prices, we proved that by static replication that they are equal to discount factor times the principal. So we took several steps, and in the end, we arrived to a fairly complex formula, and that's the formula that professionals actually use to price the swaps, with a few, adjustment, right? So there are, it's not the exact formula, right? It's very close to the formula. What's the differences, right, from the formula that banks actually use to this simplified version written here? First of all, the times and fractions are calculated using complex rules that involve holidays and day counting conventions. Back in the day, where computers were not prevalent and people were literally using abacuses and basically mechanical calculators to do interest calculations, it was easier to assume that every month has exactly 30 days. So there is a convention for the fixed leg typically, which is called 30 over 360. It means that the year has 360 days, and the month has 30 days. That essentially is just a simple way of, or convoluted rather, roundabout way of saying that each interest payment is equal, even if some months are a little longer and some months are a little shorter. Some have 31 days, some have 30, and some have 28 to 29, right? So that's just because, with computers, of course, you don't care. It's very easy, right? But before computers, it made it easier. And this convention still exists. Also, sometimes when there is a holiday, national holiday, right, you move the time T 1 day ahead or 1 day behind. So approximately, T is equal to I times tau, where tau is 3 months or 6 months. frequency, and fraction is approximately equal to tau, right? Expressed in years. So for example, for 3 months, tau is 0.25. So t in years is I times 0.25. Fraction is approximately tau, up to a few percent accuracy. And if you're doing it professionally, you need to take into account, and there's a document that describes how. And the formula for floating is only exact, this formula that I have here, when the overnight rate is compounded and certain other conditions are met. For example, sometimes the rate, there's something called lockout, where the overnight rate is not observed for the last 2 days, because if your back office or people who are responsible for sending the payment already starting to calculate and verify the payments, and they're still waiting to observe this rate, they will be delayed. So sometimes the overnight rate is not observed in the last 2 days of the 3-month period. So if we ignore all of that, then there's the expression, and only if it's compounded. When it's not compounded but averaged, in other words, the interest is collected but not reinvested, it will be slightly but not very different. Again, typically this difference just a few percent. So with that, it's 1:37, so about 2 minutes overrun planned 90-minute time. So I need to wrap up. This is the last slide for today. And the next lecture is the same time on Tuesday of next week. We will learn about risk. And the final lecture will be on Thursday of next week at the same time. And in that final lecture, we'll learn about other asset classes. So thank you. Any final questions? I'll stay in line a little longer than 2 days ago. If there are any questions, please ask. Going once, going twice. Any questions?
No, it seems that no questions.
Okay. All right, sounds good. So, well, if you think of any question, you're welcome to ask it in the next lecture.
Or you're also very welcome to email them to training@compatibl.com. So we'll also review them and answer during next lecture.
That's right. Yeah. And also I wanted to remind that after the completion of the 4 lectures, we'll have an online quiz, and based on that, we'll issue a certificate. So, if you're interested in receiving a certificate for this course, please stay on through the last lecture, and we'll have information about how to receive it at the end. So everybody have a wonderful weekend, and see you next Tuesday. Thank you.